With housekeeping behind us, I'd like to introduce today's panelists, John Eliason, Wolf Pohl, and Mark Christie. John, over to you to kick off today's program.
Great, thanks so much. And hi, everybody. It's been certainly an exciting few weeks here in Washington, D.C., as we've been dealing with the One Big Beautiful Bill and its progression, enactment into law. And then, well, we thought we were done on Friday. Then on Monday, President Trump surprised, I believe, everybody with an executive order making things more interesting. So we're certainly going to talk about those today. I'm joined here with my partners, Wolf Pohl, based in San Francisco, Mark Christie in Chicago, and just real happy to be here with you today to talk this through. When we're doing our presentation today, for many of you know, this is one of a series that we've done as we followed the One Big Beautiful Bill through the House and the Senate, and now today talking about the actual signed legislation. We're going to work quickly through some of this material to make sure that we have opportunity to answer questions. I thank you for submitting over 100 questions to the group. So we will be getting to addressing many of those in our presentation itself, but then we want to make sure that we have ample time at the end to answer questions. Naomi, can you put up the next slide, please? So before we get into it, so this is basically what we're covering today. I did want to kind of give you just a baseline of kind of where we ended up with the legislation. So as you know, President Trump signed the One Big Beautiful Bill on July 4th. So it is now law. That date was very important to the president. It was a self-imposed deadline, and if you remember in the news, President Trump was pushing for that pretty much all the way through, as were the House and Senate leaders. The House had originally passed a version of the bill several weeks ago, and there were several items in the House version that the Senate did not like. Most notably, the House version required projects to be in construction within 60 days after enactment to qualify for credits. This was really important to the House Freedom Caucus, which is a group of Republican members of Congress that I think would describe themselves as fiscally conservative and certainly looking for reducing deficit spending. The Senate then gets the bill, makes several changes to the bill, many of which were based on the Senate parliamentarian. More related to the things we're talking about today is they made an important change to that beginning of construction requirement. The Senate version gets rid of that requirement and replaces it with a 12-month safe harbor applicable to wind and solar. The Senate passed its version of the One Big Beautiful Bill on Tuesday, July 1st. Mark Christie wins a bet on the tax team of the date that the Senate would pass that. But in doing so, the Senate basically jammed the House as there was no time for a conference committee to agree upon changes between the House and Senate versions while also meeting President Trump's deadline. Remember, for the civics fans on the calls, that both the House and Senate must pass the same version of the same text of the bill for it to make it to the president. So the House Freedom Caucus cries foul because some of its important changes are removed from the Senate version of the bill, and by crying foul and having such a slim majority in the House, Speaker Johnson doesn't have the support he needs to get the bill signed into law. So here, President Trump, I'll use the term invites the holdouts to the White House. I think it was more of a summon or direct, hey guys, come on over to the office, let's talk about it, and basically cuts a deal with them to secure their votes. The executive order that we'll talk about later that was released on Monday is one of the results of that deal. Naomi, why don't we go to the next slide? Well, I think you're going to talk a little bit about some of the parts of the bill, or sorry, the act.
Yeah, so some of these credits, and these are not the renewable energy credits, the 45 and 48 credits, ITC and PTC, that we use on wind and solar or storage. but rather other credits kind of on other renewable technologies like electric vehicles, for example, or efficient energy efficient homes. These credits kind of got pared back as compared to the sort of main credits that get most of the focus, wind and solar. These ones we've noted as the biggest losers in that they got cut back rather drastically and rather quickly. Not a huge surprise here in terms of what ended up in the final bill, because this had been going back to the original House bill, which was released in May, and then working through the Senate versions that came out in June. These credits were always going to get kind of chopped back under either the House or Senate version. So the final bill cuts these out, kind of consistent with what we had been expecting sort of all along. The effective dates of when they terminate got changed for some of them through the negotiations in the various versions. But generally speaking, for these, it's September 30th, 2025. So they kind of gave us a little under 3 months from the passage of the bill, or June 30th, 2026. So a year, essentially, from a little less than a year from the passage of the bill. And like I said, these are the commercial EV credit, the new energy efficient home credit, alternative fuel, so like charging stations, and the residential clean energy credit. Mark, do you want to talk about the phase outs for wind and solar?
Yeah, so yeah, that just some phase outs in general, and some of these phase out dates shifted a little bit in the different versions of the bill, but what came out in the final bill is for purposes of section 45Y and 48E, and these are the new technology neutral PTC and ITC sections. There are different phase out rules for wind and solar versus other facilities like batteries or hydropower or nuclear. It's important to keep in mind that these are for sections 45Y and 48E. The historical PTC and ITC sections 45 and 48, which are for projects that start construction before 2025, those are not affected by these phase outs. So this is just for projects that started construction after 25 and under 45Y or 48E. So for the wind and solar, the phase out applies. You either have to start construction before the date that's 1 year after the date of enactment. So by July 4, 2026, you have to start construction, or you have to place in service by the end of 2027. For other facilities, again, like battery or nuclear or something like that, the phase out is much longer. Those projects don't start phasing out until 2034. And even in 2034 and 2035, there's a credit available for projects that start construction those years, just at a reduced amount. And that is true for storage facilities, even if they're located at a wind or solar facility. However, if they are co-located, they are separate credits. And so, if you co-locate a storage facility at a solar facility, the storage facility has the longer phase out time, but the solar facility, again, has to be constructed by July 4, 2026 or placed in service by the end of 2027.
Yeah, you're seeing in these phase outs that wind and solar are beaten up pretty bad here, but then the rest of the credit, especially the storage, it's very close to what was the law before this act was signed, right? So yeah, really a focus on getting rid of the wind and solar benefits.
Although for storage, we will need to be careful about the new prohibited foreign entity rules, which we'll talk about in a bit.
Yeah.
But that's a big change from prior law, John, for storage.
Okay, next slide. And then under section 45X, which is the advanced manufacturing production credit for manufacturers that produce certain renewable energy components like solar energy components or battery components or wind energy components. There's a phase out under the law before the act, and the act didn't change it, that starts for components that are sold in 2030. But the version before this act did not have a phase out for critical minerals. And so this act introduces a phase out schedule. It's a little different than the other phase out schedule for critical minerals that starts for critical minerals that are produced in 2031. As I mentioned, the phase out generally for other components like solar energy, wind energy was unchanged, except for wind energy components have their own phase out now, starting for wind energy components that are produced and sold after 2027. Section 48C, this is Advanced Energy Project Credit Program. There's a overall cumulative limit of $10 billion. There, under the law before this act, if a project didn't qualify, then the amount that it was allocated could get added back to that overall limit, and this reduces that. So if something gets allocated to a project and doesn't qualify, it's just lost. And then Section 45V, this is the Clean Hydrogen Production Tax Credit. So this went through a lot of changes through the various versions. This version that came out in this act is, I believe, better than any of the previous versions, but still worse than current law. Under current law, clean hydrogen has to start construction by 2033. This accelerates that, so now it must start construction before 2028 to qualify. Will, if you want to.
So yeah, some of the winners here under the bill are things that didn't get restricted or pulled in significantly. First of all, the legacy PTC and legacy ITC. So for wind and solar, we switched over to a technology neutral credit, the Section 48E and 45Y credits, which were enacted as part of the Inflation Reduction Act. The changes that we were talking about earlier relating to 2027 or beginning construction within a year, that applies to the new technology neutral credits. The legacy credits that we had been using prior to the IRA were not changed. And so those credits apply if you began construction before 2025. So as long as you began construction before the end of 2024, you can claim the legacy credits, and those ones aren't subject to these new restrictions. So helpful for projects that have a vintage that's old enough that you could get in under the legacy credits. Another change thing that got actually an extension is the clean fuel credit under 45Z. So that would have expired in 2027. It got extended, or at the end of 2027, it got extended through the end of 2029. So that's an additional 2 years. Although there's a new kind of restriction now, which is you have to produce your fuel in the US to get the credit, but previously there was no restriction on where the feedstock came from. The bill added a restriction which says to claim the credit, your feedstock must be produced in the US, Mexico, or Canada. Another sort of winner is the 45Q carbon capture credit, where really not much change there. So there were some restrictions relating to the prohibited foreign entities that got added, but other than that, the credit essentially is unchanged, other than also kind of conforming some of the credit values depending on the use of the captured carbon. And likewise, the 45U nuclear credit for existing nuclear facilities was unchanged, other than the prohibited foreign entity restriction. And another, I would say, big winner is fuel cells, which John, you can talk about.
Sure, Namba, can you go to the fuel cell slide next slide, please? Yeah, so kudos to the lobbyists for the fuel cell industry. So fuel cells, beginning next year, eligible for a 48E ITC, which is locked into the 30% percentage. So here's the one technology that no longer has to satisfy prevailing wage apprentices requirements. I don't know if that was intentional, but that's what the statute says. What they gave up for that was that they don't have the opportunity for a fuel cell project to get a benefit of the energy community domestic content credit adder. It's just locked at that 30%. And then they are also are no longer have a greenhouse gas emissions requirement, and and there were some other changes in the recapture provisions to kind of deal with removing that as well for fuel cells. But yeah, fuel cells did really well, Wolf. So it's a I don't know, maybe wind and solar needs to kind of find a new lobbyist. So we'll see. Mark, why don't we go to the next slide?
All right. Yes, credit adders, generally unchanged, just like prior versions. Still have the domestic content, energy community, low income adder. A couple of changes though to the adders worth pointing out. Under Section 48E before the act, which is the ITC version, there was a different requirement for the amount of domestic content percentage than Section 45Y, the PTC. The Section 45Y PTC stepped up over time depending on when construction started. Section 48E cross-referenced the rules under Section 48, and so sort of it read as it was locked in at 40%. And there wasn't really a policy reason that anyone could think of that there would be different rules for 48E and 45Y. And so this act fixes that to put 48E on the same schedule, subject to grandfathering for projects that start construction before June 16, which is when the version of the bill was introduced that provided some notice that these requirements were coming down. So if someone started before they had any notice, they're still using the 40% domestic content percentage. But after that, construction this year is at 40% and then steps up just like 45Y. There's also a new energy community adder for nuclear energy communities, which is generally areas that have significant employment related to certain nuclear facilities or nuclear research and development.
Yeah, other items of interest in the bill. These are some of these touch on renewable and alternative energy. Others are just more general, applying to kind of all businesses. First, transferabilities really not addressed, other than just certain restrictions about transferring tax credits to prohibited foreign entities. And there's actually some new credits that are available for transfer. 100% bonus depreciation. So we've kind of dealt with that expiring really over my entire professional career, and now it's permanent. So that's, I guess, until someone decides to change it, but at least it's permanent now. R&D expensing is made permanent. See new section 174 capital A. There is a as part of that, there's a bit of a focus on domestic manufacturing. So take a look. The 168J. So this is the business interest deduction limitation. There's some changes to the calculation. It's a little harder to just fall into accidentally. So I think that will be well received by the by business. Residential solar and wind, kind of interesting development there. And Mark was talking a little bit about the domestic content adder fix. When you're doing legislation like this under the gun, a lot of stuff can kind of slip through, and there can be things that you kind of wonder if they were intentional or if they were screw ups. So residential wind and solar, when it's subject to a third-party lease arrangement through the House and the original Senate versions we saw, the third-party leases cause the loss of the tech neutral credits associated with it. So it's a real negative to especially the residential solar business. An example of that shows up in the final legislation, but it's actually not impacting residential solar for electricity purposes. Instead, by cross-reference, it's eliminating the ability to take credits if you've entered into a third-party lease arrangement with respect to wind property and with respect to solar water heaters. I don't think that there's a really robust third-party leasing market for water heaters. I think that was kind of something people did back in like the late 80s. So the industry there certainly dodged a bullet. We'll see if that was intentional or if it was a bust that maybe gets fixed later. Geothermal heat pumps. We saw this in the original House version. It kind of stayed throughout as a relaxation of the limited use property rules. That allows it basically to just be easier to finance. There's some restrictions on property use that causes some issues on a tax analysis that should be reduced from that. The super beat provisions aren't so super anymore, which is a good thing, I think, for U.S. taxpayers. So you may have heard of the revenge tax. The revenge tax is gone, and there's a slight increase in beat. And this is part of an agreement between Treasury and the OECD members, basically providing Pillar 2 relief for U.S. companies. So if that's important to you, you'll know what I'm talking about. It's nice to get here in the act. Low-income housing, new markets, opportunity zones, are all now permanent. Really evidence that it's not that President Trump hates all tax credits. It just seems that there's a focus on the renewable space. Other things that are not on this slide that we just wanted to mention is makers depreciation. There were some changes kind of through the process of this bill becoming law with respect to solar and wind, and kind of whether they would continue to get 5 years makers treatment. And the way it was kind of became finally enacted is that it's generally under the tech neutral credits, you'll kind of remain at a 5-year makers level. If you're outside of the tech neutral credits, then you're kind of potentially under longer term depreciation, which is likely 7 years. But that's something that if that's of issue to your project, you should spend some time looking at it. And then the last item is that there was a very, very minor tweak to 707A2 of the code. This is a provision that deals with the treatment of payments from a partnership to a partner. So these are often kind of reviewed as considered the disguised sale rules, as when a contribution to a partnership followed by money coming back from the partnership will be recharacterized as a sale. The slight tweak, I think, actually probably makes it an easier case for taxpayers to consider a sale by a partner to a partnership to trigger a step up of the sold property. So more on that later, but it's just kind of interesting that it was a very, very minor tweak, but I think that it improves the argument that sale should be respected. Wolf, I know lots of people were asking us questions about the prohibited foreign entity rules and kind of everything that's comes through that. I know you're going to take us through that.
Yeah, and this concept, this is a new concept, prohibited foreign entities, and essentially says that you cannot get tax credits if you have too much involvement from specified prohibited foreign entities. And really what this is targeting really seems policy-wise to be targeted towards China. So trying to not have too much Chinese involvement in the renewables projects. It actually covers 4 nations. So China plus 3 others, Iran, North Korea, and Russia. But it does seem policy-wise that it's sort of geared towards restricting Chinese involvement. And so we've talked about these kind of previously in the prior versions of the bill. There were some minor changes in the final version that got enacted as compared to the last Senate version, but the overall concept remains the same. So you're a prohibited foreign entity if you have too much Chinese involvement, meaning too much direct or indirect ownership, too much lending from a Chinese entity. If you're a specific listed type of foreign entity, if you have too much foreign influence, which kind of covers a lot of concepts on a very broad set of concepts around the contractual provisions and licensing that you have for the equipment in your project. So something that we need to be kind of careful of in looking through direct and indirect ownership in entities and investors in entities, but then also what are the contractual arrangements that we're using to obtain our equipment or use our equipment, and does that give a Chinese entity kind of too much control or influence over the project? And then the second kind of broader category of PFE rules are the material assistance rules. And those talk about having too many Chinese components in your project. And that ramps up over time in the Senate version, which made it into the final bill. The House version would have prohibited any components after a certain point in time. But this just ramps up percentage-wise the amount of non-Chinese components that you need to have based on when you began construction in order for your project to be able to claim the credit. Next slide, please. So I don't think we'll spend too much time going through these because we've talked about them before in our prior webinars, but these kind of stayed the same. These are so one category of PFE is a specified foreign entity with certain kind of like listed out entities, including corporations that are formed in China. Chinese nationals or citizens would be kind of part of the specified foreign entity category. Next slide. So then foreign influenced is looking at, as I was saying, looking at whether you have a specified foreign entity can appoint members of the C-suite or members of the board on an entity, or if you're making payments under a licensing agreement or some other arrangement that's giving this kind of new concept of effective control to a prohibited foreign entity. So a lot of new rules in these kind of embedded in the code that I think people will need to work through as we're doing projects in the future, and we need to make sure that we don't either have either of the ways to be treated as a prohibited foreign entity. Next
These
slide.
rules are not the model of clarity, right? So here's an area where Congress has delegated some rulemaking authority to the Treasury to kind of come up with some rules behind this stuff, but when you work through this, you realize that it's very complicated, and I'm afraid that there will be some footfalls that people may stumble.
Yes, yeah, definitely a lot of kind of new issues that people will need to work through, right? And hopefully we get guidance fairly soon detailing how to kind of figure this out in practice.
Mm-hmm.
So the other big rule is this material assistance rule. Mark, do you want to take this one?
Yeah, so that's another prohibited foreign entity rule. It applies to certain code sections, Section 45X, Advanced Manufacturing Production Tax Credit, and then the PTC and ITC 45Y and 48E. So the rules that Wolf was going over, those are sort of, first looking at who can claim the credit. You can't be a prohibited foreign entity to claim the credit. But then, they apply here in terms of when you're constructing a project, you can't get material assistance from one of those prohibited foreign entities. So again, that means particularly, from China, like a certain amount of the components that go into a project, there's restrictions on how much of that can be Chinese equipment or one of the other prohibited foreign entities. So this new rule applies for projects that start construction after this year, after 2025. And then we'll talk about this later, but for purposes of this rule, the act actually codifies the existing started construction guidance. So we've been using started construction rules for a variety of purposes in the past, and they've come from IRS notices. And the act refers to those IRS notices that were in effect as of January 1, 2025 for purposes of these rules. So if a project starts construction under the existing started construction guidance this year, it's not subject to these material assistance rules. the material assistance test is quantitative, and it's based on when construction starts, and it's basically how much of the cost of the percentage of the total cost of your manufactured products can be produced by prohibited foreign entities. So the amount ramps up over time based on start of construction. So for qualified facilities, it's 40% of non-prohibited foreign entity components, I'll say, before or during, if you start construction in 2026, and then that goes up 5% each year thereafter. For energy storage, this wasn't in the previous versions, I don't believe, but energy storage actually has a higher rate. So batteries, this is one of the areas where batteries maybe didn't come out as well as even though it has a longer phase out period where it's going to have a higher percentage of non-prohibited foreign entity components in order to qualify starting next year.
Yeah, we're not sure what happened there. We were kind of talking about that before this, about the energy storage technology not kind of not doing as well under the threshold percentage as the everything else.
Right. But actually, can we go back? I'll just have a few more things to point out here. So we're gonna, until we get guidance, on figuring out what these total costs of manufactured products are, the Act directs us to look at the domestic content guidance under the IRS domestic content guidance. The IRS has tables listed for different types of technology like solar and wind, and there's deemed cost categories. So for example, solar has different listings for things like PV modules, and then the components, the cells or frames. So we can use the domestic content guidance to look at what's a manufactured product, and suppliers will have to certify to what the costs were and what the components were that were manufactured by prohibited foreign entities. And a couple other things to point out is that there are lower thresholds to impose accuracy-related penalties if a taxpayer loses a credit because of a failure of this material assistance rule. They're more likely to also face additional penalties, accuracy-related penalties. There's also penalties on suppliers if they've supplied these certificates and they're wrong and the taxpayer loses a credit. And lastly, the statute of limitations here, which is generally 3 years after you file a return, is 6 years for this issue. So gives them a longer time to take a look.
Yeah, Mark, we had several questions about the supplier certificate, and it should be interesting to see how that's perceived in the market. I mean, it's obviously important for the to qualify for the credits, but with that penalty imposed on the suppliers and the way that the certification, what they're certifying, basically kind of looking all the way upstream is like, where do they get the stop? And that's
right.
We have ideas about that, but it's this is another place that I think having some additional guidance would be very helpful.
Right. Yeah, it's not entirely clear. Cool. And then so under section 48E, there are new recapture rules. There's the existing recapture rules are still in place, but there's new recapture rules that focus on situations where, again, generally like a Chinese entity has effective control during a 10-year recapture period. And Wolf kind of went into those rules, basically certain contractual arrangements that give an entity contractual control over a project. If that happens and a taxpayer is making payments to that entity pursuant to the contract during a 10-year period starting when a project is placed in service, there's 100% recapture. There's no vesting for this. This does apply only for taxpayers allowed a credit under 48E beginning 2 years after the date of enactment, or taxable years beginning 2 years after the date of enactment. So for most taxpayers, that's going to be claiming in 2028. So that's when that will start to be effective.
Okay, so if you dialed into the webinar just because you wanted to talk about executive orders, start paying attention, because now we're going to start talking about the order that came out on Monday. So this is the deal to get those House Freedom Caucus votes. Executive order issued July 7, 2025. the by its terms, primary purpose is to kind of make sure that that there's not abuse in qualifying projects under that 12-month safe harbor that that the Senate came up with and is in the enacted legislation. Naomi, can you go to the next slide? So to kind of start the discussion, since we're going to be talking about beginning of construction a little bit, we thought it'd be helpful to just give you a brief reminder of what we've been basically living with for the last 12 years. So to demonstrate begun construction for purposes of qualifying for tax credits, and it actually, there's vestiges of this back even in the depreciation days and certainly under the 1603 cash grant program. The IRS put out a series of notices and that have been updated them over the years, with the last real relevant update for us being in 2022, just confirming that that the start of construction rules prior to the Inflation Reduction Act passing still applied for purposes of going forward. So really at a high level, there's two methods to establish when construction begins, and in doing so, you really have both methods have two prongs. So the first prong, you've actually got to commence construction. So commencing construction is either starting actual physical work, which can be on-site or off-site. The notices tell us that there's no minimum amount of work required or minimum cost. If you're active in this industry and have dealt with these rules, especially in connection with a tax equity transaction or a financing, you'll know that notwithstanding the notice telling us that it's an extremely low bar to demonstrate actual physical work, that counterparties, lenders, tax equity investors will want to see some amount of work being done that's above those bare requirements to avoid just being viewed as insignificant or de minimis. The second way to commence construction under prong one is to satisfy what's known as a 5% safe harbor. That's a spending requirement that, depending on your accounting method, either cash method or accrual, whether you've paid or incurred at least 5% of the ID costs in a year. When you've done that, you've satisfied prong one. Prong two for both of the physical work test and 5% safe harbor is making continuous progress towards completion or continuous efforts. That's a facts and circumstances test, and that IRS notices give us some excused interruptions. But more importantly, they give us a continuity safe harbor, which tells us that if we complete our project by the end of the year, which includes the 4th anniversary of the beginning construction date, we're deemed to have satisfied prong two. So we don't have to prove up that we've been working on it on a regular basis from beginning to end. So that's obviously a very, very favorable safe harbor, and on pretty much all the projects that we see constructed are benefiting from that kind of safe harbor, as opposed to trying to demonstrate facts and circumstances, because that's just more subjective. Naomi, next slide, please. I think, Wolf, can you kind of talk us through a little bit more of the details in the executive order? And we'll stay on this slide for a bit and just have a discussion about kind of what we're seeing here.
Yeah, so this executive order instructs the Secretary of the Treasury to, one, strictly enforce the rules relating to beginning of construction, strictly enforce that sections 45Y and 48E are intended to be terminated for wind and solar, either based on that 2027 deadline, place in service deadline, or based on beginning of construction before July 4th of 2026. And instructs the Treasury to issue new guidance, kind of addressing, preventing taxpayers from circumventing or manipulating the rules that have been established for beginning of construction. And kind of interestingly, aside from the executive order, the code, what was passed in the final bill, had two provisions mentioning the existing beginning of construction guidance. One provision, as Mark was mentioning earlier, which codified the existing begun construction guidance, at least for purposes of determining material assistance. So saying the begun construction rules as they were developed under the notices should stay the same. But then also another provision in the code saying Treasury should issue guidance around preventing people from circumventing these rules, including by stockpiling equipment. So we have we have one provision in the code telling us that the rules should not change. Yet we have another provision in the code saying that rules should be issued to prevent circumventing of the existing rules. And now the executive order issued on Monday, which kind of says a similar thing, which is Treasury should issue guidance preventing the circumvention of the existing rules, and also mentioning not using broad safe harbors. So I think that the kind of the crux of the executive order and its effect will be, what does the IRS or the administration think amounts to circumventing the rules? And how does that align to how people have been planning in the past or will be planning in the future to begin construction? And whether that's a, kind of huge reworking of the beginning of construction guidance, which has been developed for over a decade, going all the way back, as John was mentioning, to the 1603 program in 2009, or whether that's sort of a more targeted, change in terms of finding things that are abusive or truly circumvent the existing rules as they've been established, and clarifying that those things don't work. But I think, as John was pointing out before, most of the industry kind of has assumed that the beginning of construction rules would be strictly enforced if the IRS were to audit a project. And I think most people are trying to kind of comply with these beginning of construction rules as they've been developed. And Congress at least seemed to have the intent that the beginning of construction rules should not be changed in terms of the kind of technical requirements needed to begin construction in the future. So we'll see how this plays out.
One of the immediate things that's happening is it is chilling the market a little bit, right? Because we know that the Treasury has now been instructed to provide additional guidance in the next 45 days. So people are kind of thinking, hey, it's the middle of the summer. Maybe we'll wait it out and just see what that looks like. Because there is concern, and we've gotten, I don't know, probably 50% of the questions we've received today are related to started construction, this specific issue. There's concerns about changes that could happen that would be viewed as retroactive, right? It's like, is everything that we've been doing for the last 12 years wrong based on some new notice? Or is it going to be proactive or forward-looking, I should say, in the sense that are we just dealing with this period now that this bill's been signed, and we know that we have this cutoff for wind and solar coming, and we have this 12-month safe harbor? Is it just going to be focusing on that? And I don't know. It's kind of interesting. And just kind of talking to others, we know that members of the Senate who pushed for the 12-month safe harbor, I'm not sure knew this was coming out. Although I think that if they'd sat down and thought about it, I'm not sure that this wouldn't be something that you'd think of, kind of knowing that the House was getting jammed with the Senate version of this. But our understanding is that some of them are just not happy with what looks like the White House usurping their authority. And I feel like that's just kind of creating a very difficult thing for Treasury to thread, and kind of dealing with the existing law, dealing with the codification in part on the of the existing, and then also this directive. So I'm kind of of the view, and guys, we should probably come up with another bet of what this is going to look like. But I'm of the view that this is probably I don't think it is going to be retroactive. I think it's probably going to be more just kind of forward looking, and it may be quite limited. It may simply because the IRS has given us guidance, which has now been codified, that really creates a very low bar.
Yeah, I mean, we have a lot of history of IRS guidance in this space, and none of it has been retroactive. And even within this act, when there are rules in place, even like the domestic content one that I talked about, there's at least, one, until you had noticed that there was going to be a change in the rule. If you started construction before then, you're usually grandfathered. And so it would be, unusual based on sort of historical experience, the way like start of construction has worked for it to be retroactive. But so it would be very unusual. It's also interesting that there's there's a 12-month period for the termination of the wind and solar. So that takes us till July 4, 2016. That's one of the relevant dates we have for start of construction. The other relevant date is by the end of this year to get out of the material assistance rules. So if there's, and that one is the one where they codified the guidance. And so how are they going to go about issuing guidance that's, it has to be, they've already codified the guidance for purposes of the material assistance rules throughout this year, but new guidance that applies for the 12-month period. So if someone starts construction at the end of this year, are they going to have two different sets of start of construction rules, or, it's not all that clear.
Yeah, or specifically, what would be changed? Is it a change to the 5% spend threshold? Is it a change to the continuity safe harbor, a shortening of the continuity safe harbor? But those things, have been codified and established over a long period of time. So changing those rules would seem kind of like something that the Treasury wouldn't want to do, because then you'd have to have some other rule as to what it means to begin construction, which would be kind of disruptive. So.
Yeah, no, the executive order includes a specific language that it's looking to have a substantial portion of the subject facility has been built, right? So that to me is a deviation from existing start of construction notices. It suggests to me that they are looking, or we may be seeing a higher spend percentage, Wolf, like you mentioned, or maybe they want to see kind of more activity on the ground, or maybe they'll say that for during that period that the continuity safe harbor doesn't apply. And I feel that Treasury, but for, and maybe it's a huge exception, but for Mark, your point with respect to kind of what's happening for FIAC purposes, I do feel like that's within the authority of Treasury to kind of make those types of changes in response to this executive order. But once again, I think it's a tough job. We were kind of wondering when we were discussing this amongst ourselves is whether this was also just a directive to the IRS to make sure that they're strictly enforcing these rules. So to Will's point, I mean, that's how we've been reviewing these for kind of as long as they've been out, is that these are actually important rules that have to be followed. But I can't remember. I don't think any of us do really any audit activity associated with start of construction. So maybe this is a message to the IRS that, hey guys, make sure that this stuff's being complied with to really prevent that abuse. So yeah.
And it is focused on circumvention and abuse of the existing rules, as opposed to a directive to change the existing rules. So my examples of, could they shorten the continuity safe harbor? Could they change the spend threshold? That wouldn't, in my view, at least, really fall into the bucket of stopping circumvention of existing rules. So hopefully, as you say, John, they'll thread the needle in a way that isn't too disruptive to the industry.
And when we're kind of thinking about like when that would be effective, I'm less worried. I was, when it first came out, I was a little bit more concerned about a retroactive or just kind of creating a squishy rule here that then everybody gets freaked out about their start of construction strategies they've already put in place. As I've kind of been thinking about it more, I think that if forward-looking guidance, I think it could be effective as of the date of enactment of the bill. So that would be as of July 4th. I could also see it happening at that 60-day mark. Presumably the House in their version of this bill were okay with the existing guidance on starting construction through that 60-day period. So you could see, well, maybe the first 60 days is good, and then after that you have this heightened requirements. I don't know, but I'm hopeful we see something soon, because it is it's putting some deals already on pause, or people are kind of looking at it and just kind of seeing how to respond. And whenever you have uncertainty in our business, it slows things down. So hopefully we'll see that additional guidance soon. So yeah, why don't we go to some questions? And thank you again for providing them. I think several of them we've answered in this presentation, but we can jump into it. So I'm going to start with a softball, which is kind of not related to what we're talking about, but it's just so funny it has to be asked. Is the easiest path to EU citizenship? That is the question. That if you've asked that question, thank you for making us smile. I think that Portugal has a golden passport. I'm not 100% sure, so I encourage you to talk to an immigration lawyer for the easiest path to EU citizenship. We're probably not going to be much assistance on that one. Okay, so kind of other things. Lots of questions about executive orders and whether they are what their level of binding nature of them from a law perspective, kind of what they do. We generally, and guys, correct me if you feel differently, but we generally don't view executive orders as having the same binding authority as a statute. Often they're not covered in typical change in tax law provisions, but the regulations that'll come out of it, or IRS guidance, if the executive order is directing the IRS to do something or Treasury to do something, what comes out of that is likely has that administrative authority, either through regulations or binding IRS guidance. So it's certainly, an executive order is certainly something to be reviewed and with care, and not just simply ignored and thinking it has no force of effect. It's causing someone somewhere to start working on something. So yeah, guys, any additional thoughts on that?
Yeah, I think that's right. I mean, there's more question nowadays about through some recent Supreme Court decisions about what Treasury can do as far as, regulations, or any agencies can do. There's grants of authority though for Treasury to do different things throughout the statute. So just going back to sort of the beginning of construction, whatever they do can't be, I don't think, inconsistent with the parts where begun construction is codified or something like that. They have to have authority, and those regulations can be challenged, but I agree with that.
We have a question who I'm guessing is from a lawyer about the extent in which the Chevron's repeal impacts us, right? So the repeal of that's a repeal of doctrine to basically give deference to executive branch with respect to questions, as opposed to just kind of having a court look at it. So just because the IRS says something is started construction in a notice, with a repeal of Chevron, you'd think that a court would be looking at it and deciding if they agreed to it or not. So, I mean, I think that could really cut both ways, I think, right? Because our IRS notices, as we've said, have a very, very low threshold for beginning construction. So I guess with a repeal of Chevron, if a court looked at it, they could decide there's a higher standard, although that's probably not a case that's making it to court. But yeah, interesting question. So we have some questions with respect to FEOC about whether FEOC applies beyond renewable energy. I think it would have, it's a qualification, it's a credit qualification, right? So I think that if everyone remembers the Senate's version with the excise tax, that would have applied to renewables beyond credits. But Wolf, do you have thoughts on on that? I mean, it seems to me that it's more from a qualification question or eligibility, and that's it.
Yeah, I think it only impacts your ability to claim the credit. So, if you were building, let's say in 2030, and let's say we get to 2030 and the rules haven't changed in the meantime, you're building a solar plant in 2030 that's not going to qualify for any of the credits, then in that case, I don't know that you need to worry about the prohibited foreign entity rules.
Yeah, I mean, one thing to keep in mind though is the recapture rule that Mark talked about, right? So even if you've claimed a credit, there's a tail that you do need to worry about this stuff. So even if you're outside of your 5-year recapture period, you have another 5 years that you're worried about it, or you may trigger recapture to the extent those provisions apply. We have a question about the change to section 48 of the code, which we talked about. So this is like the removal of the other energy property. I don't know, if, Mark, if you want to talk about that a little bit, going away.
Yeah, I mean, there was a provision that's been in section 48 for some time that sort of gave a residual credit to energy property that didn't meet the requirements otherwise listed of, I think it was 10% total. So you could kind of go on forever getting a 10% credit, even if you didn't meet whatever like construction requirements or things like that were in there. And so that is eliminated now is it for June 16 start of construction? Yeah.
I think that's right. But, kind of importantly, I don't think most people did not plan into using that 10% credit.
No, I think that's right. I remember it coming up
So
when we had like the phase out. Before we had the IRA, it was sort of thinking like, there was still this residual credit
right.
in there.
Yeah. So yeah, pre-IRA, if you ran out of time, you could not get the 30% ITC, but you could get a 10% ITC sort of forever. And the IRA left that in there. So it would have been a useful backstop if we got to a point where when we get to the point where the renewable tech neutral credits aren't available anymore and you cannot get a 30% ITC. If this had been left in there, you'd have kind of an indefinite 10% ITC going forward into the future. But it was sort of surprising that it wasn't carved out of the IRA when the IRA was passed in any event, because they were trying to switch it over to the tech neutral credits at that time in the first place. So I would say not too surprising that got removed in this bill.
We had thank you. We have some started construction questions, which I think I probably answered when I was talking about with the beginning construction rule, but just to kind of make sure people understand is that if you've incurred significant costs and with respect to like getting an interconnection, queue position, or development costs and those things, that's not providing you any protection that you've started construction, right? You've actually got to have to actually start work on the project. Often we'll see people historically have kind of gone the offsite route strategy if they didn't necessarily have their project totally buttoned up. But just know that that's not, but those types of soft costs they're not going to quite do it for purposes of kind of coming within that 12-month period. So so just something to keep in mind. So we're at time. Thanks for the time today. I encourage you. I mean, we make it to pretty much all the major conferences. I encourage you to seek us out. Let us know what you thought of the presentation. Let us know if you have other questions. We're always happy to kind of help in any way that we can. And then I'll also suggest you take a look at the Orrick's webpage, which will include a copy of this presentation as soon as it's uploaded, and it has our prior presentations on the House and Senate bills, and then just other updates of what's going on. When we see a notice eventually from Treasury interpreting this, unless it's so straightforward that it doesn't deserve a discussion, which is probably not the case. Hopefully we'll be back and you'll join us and we can talk through that and discuss how that may impact your project. But thank you again and have a wonderful day.
Thank you, everyone.